Hello, in this video, we're focusing on the practical concepts that you can actually apply in the real business world. Hope you enjoy it. Let's get on with it. Today, we're going to explore practical strategies that can help increase your company's value. As you can see in this image, small businesses are represented with stacks of coins and a rising bar graph, symbolizing growth and financial improvement. Throughout this presentation, we will look at effective approaches to boost your company's worth, covering key areas such as improving operations, enhancing customer relationships, and smart financial management. By the end, you'll have a clearer idea of actionable steps to strengthen your business and drive sustainable growth. Let's get started. Building a valuable company isn't just about growing revenue or profits over many years. It's also about making the business attractive to buyers, investors, and partners by improving things like risk management, predictability, scalability, and operational efficiency. Sometimes a company can quickly increase its value by focusing on the right areas, even if its headline numbers don't change. For example, two companies with the same profit can have very different valuations if one is better organized or less risky. This presentation focuses on practical strategies that can be implemented right away to enhance value in the real world, showing why they work, how to apply them, and what benefits or drawbacks they might have. We'll look beyond theory to uncover what truly matters to those who decide a company's worth. Increasing your company's value right now offers real advantages, even if you're not planning to sell. A higher value business gives you more options, like selling a stake, raising funds, refinancing loans, or inviting partners under better terms. This added value acts as leverage in different situations. It also strengthens your position when negotiating with investors, suppliers, or lenders, because a well-structured, low-risk company is seen as more stable and trustworthy, which usually means better deals. Additionally, many value-boosting actions, such as diversifying your client base or improving internal processes, help your business become more resilient. This means you're better equipped to handle economic challenges, staff changes, or market shifts. Lastly, these improvements don't just offer short-term gains, they often support long-term growth by increasing cash flow, providing clearer financial insights, and reducing reliance on any one person. All these factors together make your business stronger and more flexible in the face of whatever comes next. A key way to increase your company's value is to focus on improving the quality and sustainability of earnings, rather than just boosting profits. This means cutting out one-off or unusual costs that can distort your financials, making sure the owner's pay aligns with the market, and sometimes letting go of unprofitable customers or products. It's also important to prioritize margin stability over chasing higher revenue, and to work on turning sales into actual cash quickly by reducing outstanding receivables and excess inventory. These steps make your earnings more predictable and consistent, which investors really value. For example, a professional services firm earning £500,000 annually had big fluctuations in profits because their work was project-based and irregular. By switching to contracts with regular monthly fees and dropping clients who brought in low profits, they made their earnings steadier. Even though their total earnings didn't change much, their business was valued much higher because of this stability, with the valuation multiple increasing from 4 times to 6 times EBITDA. This shows how cleaner, more reliable profits can significantly boost your company's worth. Businesses that depend heavily on their owners are often seen as risky because their success feels tied to one person. To reduce this risk, it's important to delegate key client relationships to experienced staff and make sure all processes and workflows are clearly documented. Building a solid management team beneath the owner allows the business to run smoothly without the owner's constant involvement. Taking the owner out of daily operational decisions not only frees up their time, but also lets managers take more responsibility, especially when performance-based incentives are introduced. This approach makes the business more transferable and attractive to buyers. For example, a marketing agency that was initially undervalued because the founder managed all major clients increased its sale price significantly by appointing account directors and formalizing handovers, which boosted buyer confidence. Creating a business that can operate without the owner boosts its value and reduces perceived risks. Providing clear and credible financial information reduces uncertainty and immediately boosts how people value your business. To do this, it's important to produce monthly management accounts that give you a regular, detailed picture of your company's performance. Keep your personal and business expenses separate to avoid confusion and ensure accurate reporting. Regularly reconcile your cash flow statements so you have a true understanding of your liquidity. Implement budgeting and forecasting processes to plan ahead and anticipate challenges. Using professional accounting standards consistently also builds trust and credibility. Poor financial clarity, even if your business is profitable, increases risk in the eyes of investors and buyers, which lowers the multiples applied to your valuation. For example, a retail business with strong cash flow but messy accounts struggled to attract investors at first. After 6 months of improved financial reporting and clean, well-organized accounts, investor interest grew significantly, and the company's valuation expectations rose materially. This shows the real impact strong financial reporting can have on perceived business value. Customer concentration can be a big risk because if too much revenue comes from one client, losing that client can seriously hurt the business. To reduce this risk and boost value, it's important to limit reliance on any single customer by securing a more balanced mix of clients. Offering complementary products or services can attract different customer groups, and expanding into new markets or segments helps spread risk further. Long-term contracts bring stability, making revenue more predictable. When a business has diverse revenue streams, it tends to be more stable and attractive to lenders or buyers. For example, a logistics firm once earned 60% of its revenue from a single client. By gaining 2 more large customers, the company lowered its risk profile, which helped it get better financing terms and increased its overall enterprise value. This shows how diversifying customers and revenue streams can quickly and effectively improve business value. To increase company value, locking in revenue through contracts and subscriptions is a powerful strategy because predictable contracted income is highly valued. Start by converting clients who currently pay on an ad hoc basis into subscription models, which provide regular, recurring revenue. Introduce long-term service agreements to extend the commitment period and build stability, including automatic renewal clauses in contracts, can further reduce churn and make revenue streams more consistent. Offering incentives for upfront payments or multi-year deals encourages customers to commit longer, improving cash flow and forecast reliability. Recurring revenues minimize the fluctuations in your income and make future performance easier to predict. For example, a software company shifted from selling one-off licenses to subscriptions, and even before their actual revenue grew, their valuation multiple increased because investors saw the improved revenue visibility and reduced risk. This kind of revenue model strengthens your overall financial position and enhances company value. Reducing unnecessary costs can boost your margins quickly, but it's important to do this without harming the core capabilities your business needs to grow. Start by renegotiating supplier contracts to get better deals or more favorable terms. Look closely at your operations to identify any roles or tools that are redundant and can be removed or streamlined. Outsourcing non-core activities can also be a smart move, allowing you to focus on what you do best while cutting costs. Make sure your cost base matches your demand levels so you're not overspending when business is slower. This kind of careful cost optimization helps improve profitability and makes your business more efficient without sacrificing long-term potential. For example, a manufacturing company increased its EBITDA by 15% through supplier renegotiations and adopting lean processes, which raised its overall value even when revenues stayed the same. Building strong governance and risk management practices is key to boosting confidence among investors and buyers. Start by forming a formal board or advisory group to provide oversight and strategic direction. Implement clear internal controls and define approval limits to maintain operational discipline. It's important to address any gaps in regulatory compliance to avoid potential penalties or disruptions. Securing critical intellectual property rights ensures your unique assets are protected, adding value. Also, keep contracts and legal documents current to minimize legal risks. By proactively reducing both legal and operational risks, the business becomes more attractive and reliable, which ultimately enhances its overall value. A clear strategic vision provides direction and purpose, showing how the business plans to grow and succeed over time. Identifying scalable growth opportunities helps focus efforts on areas with the most potential to expand, whether through new markets, products, or customer segments. Aligning key metrics with these strategic goals ensures progress can be tracked and communicated effectively, demonstrating execution capability, proving that the team can deliver on plans, builds confidence in the business's future. Together, these elements create a credible growth story that moves valuation beyond past results toward the value of what's achievable next, helping investors and buyers see solid future potential clearly. These value-boosting strategies have a number of clear benefits. They can quickly increase valuation multiples by making the business more appealing to investors and buyers. This improvement builds their confidence because the company shows less risk and more stability, which puts you in a stronger position during negotiations. Additionally, these strategies help reduce overall business risk and lead to better internal decision-making since the company becomes more organized and focused. They also ensure that the business is aligned with long-term sustainability, creating lasting value beyond any potential sale. In other words, even if you never sell, these actions improve your company's health and future prospects. While these value-boosting strategies offer clear advantages, it's important to be aware of their limitations. Focusing too much on short-term gains can cause us to miss opportunities for long-term growth and sustainability. Some changes, especially those involving culture, require time and commitment to take root, so they can't be rushed or forced. Over-optimizing processes or cutting costs too aggressively might actually harm the company's capacity to grow or deliver quality service. Additionally, not all key factors that drive value are within our direct control, which means external conditions can impact results. If these strategies are executed poorly, they can lower employee morale or reduce the quality of service our customers expect. The key is to apply these approaches thoughtfully and adapt them to the unique needs of the business, rather than just following a checklist or formula. This balance ensures we build lasting value without unintended negative effects. Increasing your company's value doesn't always mean waiting for years of growth or perfect market conditions. By focusing on key areas like improving the quality of your earnings, reducing risks, maintaining transparency, building scalability, and strengthening governance, you can create lasting value more quickly and sustainably. Areas matter most to investors and buyers because they look for businesses that generate predictable cash flows, have low risk, and show clear potential for future growth. When you align your business with these priorities, you position it strongly for valuation growth that can make a real difference. If you found this video useful, there's plenty of more business and finance videos on the channel that you'll enjoy watching and get great practical value from. In the meantime, thanks for watching.